In April 2023, Bed Bath & Beyond filed for Chapter 11 bankruptcy. It had 360 stores left, $5.2 billion in debt, and fewer than 18 months earlier, it had been worth $1 billion. This was not a company that failed because Amazon appeared overnight. Bed Bath & Beyond dismantled itself, one decision at a time. At its peak in 2012, this company ran nearly 1,500 locations across North America. Revenue hit $12 billion in fiscal 2018. The stock once traded above $80 a share. By January 2023, it was trading below $1, down more than 99% from its all-time high. Warren Eisenberg and Leonard Feinstein opened the first Bed Bath & Beyond in 1971. They started in Springfield, New Jersey, in a single rented space. The insight was simple but powerful. Sell home goods at a discount, in depth. Not one brand of towel, 30 brands, every price point, floor to ceiling. Shoppers walked in for a sheet set and stayed for 45 minutes. By 1992, the company had gone public on the NASDAQ. Investors noticed immediately. Through the 90s, the big box format was the future of retail. Circuit City, Home Depot, Bed Bath & Beyond. These stores seemed unstoppable. BB&B was added to the S&P 500 in 1999. The company became expert at one specific weapon, the coupon. The Big Blue 20% off mailer became a cultural institution. 50 million coupons mailed every year. 1 billion pieces sent over the program's lifetime. Shoppers planned their purchases around it, but so did Bed Bath & Beyond's competitors and its suppliers. The coupon cost the company real money every single time it was redeemed. Management accepted that cost for decades because traffic kept growing. When traffic stopped growing, the coupon became a trap. The company had trained its own customers never to pay full price. By the mid-2000s, gross margins were already under 35% and declining. In 2019, a new CEO arrived named Mark Tritton. He came from Target, where he had been chief merchandising officer. The board hired him to remake the company. He tried. Tritton's strategy centered on private label brands. He launched 8 new owned brands in under 2 years. Names like Nestwell, Simply Essential, and Haven. The logic was sound. Private labels carry higher margins than national brands. Target had proven this with Cat & Jack. Costco had proven it with Kirkland. The problem was execution. To make room for the new brands, Tritton cut the national brands customers came for. Brands like Cuisinart, KitchenAid, and Dyson started disappearing from shelves. Shoppers noticed immediately. Sales fell 11% in a single quarter in 2021, and that was before the supply chain collapsed. In 2021, global shipping costs exploded. Lead times stretched to months. National brands had backup inventory. BB&B's new private labels did not. Shelves went empty during the holiday season of 2021. That quarter, comparable sales dropped 22% year over year, but none of that was actually the original sin. To understand why this company truly had no way out, you have to go back to 2004. That year, Bed Bath & Beyond began buying back its own stock. Over the next 15 years, the company spent $12 billion on buybacks. $12 billion. That was money that could have funded a real e-commerce platform. It could have funded supply chain infrastructure or private label development that was actually ready before the brands went to shelves. Instead, it went to shareholders in the short term. And by the time Tritton arrived, the company had almost no cash left to work with. He was being asked to rebuild a burning building with a garden hose. Meanwhile, the short sellers arrived. By early 2022, roughly 50% of BB&B's float was sold short. The company had become a betting market. Then, in January 2022, a 25-year-old investor named Ryan Cohen entered the picture. Cohen had made billions turning GameStop around, or so the story went. He published an open letter demanding the company explore selling itself or its bye-bye baby division. The stock jumped more than 70% in a single week. Reddit traders piled in. The meme stock machine spun up. In August 2022, Cohen sold his entire stake near the peak. He made approximately $68 million on the trade. The stock crashed 60% in 3 days. Individual. Investors who had bought the hype lost tens of millions in aggregate. And the company's actual problems had not changed at all. 3 weeks after Cohen sold, Tritton was fired. He had been CEO for less than 3 years. The board replaced him with Gove, a retail turnaround specialist. Gove announced store closures. 150 locations shut immediately. 12,000 employees lost their jobs in that single round. The company burned through cash at an alarming rate. In fiscal Q2 2022, operating cash outflow was $500 million. Suppliers began demanding payment upfront instead of on credit, which meant shelves emptied again. In November 2022, the company warned it might not survive. That phrase, going concern, is the legal equivalent of a death rattle. The company attempted one last fundraise, a stock offering in early 2023. It raised $225 million by diluting shareholders further. It was not enough, not even close. On April 23, 2023, Bed Bath & Beyond filed for Chapter 11. The filing listed $5.2 billion in liabilities and assets of $4.4 billion. The gap was unbridgeable. By the end of June 2023, every single store was gone. The Bye Bye Baby brand, which Tritton had been pressured to sell and refused, also shuttered. 32,000 employees lost their jobs in total. The name itself was eventually sold to Overstock.com for $21 million, a brand that had once been worth billions, sold for the price of a small apartment building. The physical stores went to liquidators. The digital domain went to Overstock. The 52-year-old company ceased to exist as a real business. What is left is a website run by a competitor using a dead brand as an SEO vehicle. The reason list for this collapse comes down to 5 specific failures: a coupon strategy that hollowed out margins for 2 decades, a private label bet that removed the products customers actually wanted, $12 billion in buybacks that stripped the company of every dollar it needed to adapt, a leadership merry-go-round that produced 3 CEOs in 4 years, and a debt load taken on to fund those buybacks, with no cash cushion when things went wrong. Amazon did not kill Bed Bath & Beyond. The company spent the money it needed to compete on rewarding shareholders in the short run, and when the environment got hard in 2020 and 2021, there was nothing left in reserve. Every retailer faced the pandemic. Every retailer faced supply chain chaos. Target, Walmart, and Costco survived because they had spent years investing in logistics and loyalty. Bed Bath & Beyond had spent years buying back its own stock. In April 2023, those two paths diverged completely. The stores that invested are still open. The one that chose buybacks is now a website that used to be something else. In April 2023, Bed Bath & Beyond had $5.2 billion in debt and $0 in reserve. That number does not happen by accident. It happens when a company optimizes for the stock chart instead of the store, when short-term shareholders are treated as the customer instead of the people walking the aisles. Bed Bath & Beyond had a clear view of its competition for 52 years. It could see Amazon growing. It could see e-commerce reshaping retail. It just kept mailing the coupon and buying back the stock. There is a certain category of corporate failure that is not about disruption, not about a startup that out-innovated them, not about a pandemic that nobody could have predicted. It is about a company that had the resources to change and chose not to spend them on the future. Bed Bath & Beyond is that category of failure. $12 billion. That was the cost of a business deciding its own present was worth more than its future.